What if the most powerful tool governments use to save the economy is actually poisoning it?
And why could your parents buy a house on a normal salary, but you can't?
Why do your savings earn nothing while housing and stocks just keep climbing?
4,000 years ago, Mesopotamian farmers understood something we've forgotten.
Today, we explore one idea. Interest is the price of time. Distort it, and you distort everything.
Welcome to Nonfiction Insights, where we break down big ideas so you can actually understand them.
Our mission today is a deep dive into Edward Chancellor's book, The Price of Time.
And we're going to analyze his core argument, which is that the decision by central banks to keep interest rates ultra low is maybe the root cause of today's instability.
And the inequality, the housing crisis you're seeing everywhere. Okay, so let's get into it. Let's start with the big idea, the philosophy.
I think that's crucial because for most people, interest is just, what you pay on your credit card.
Right, or a mortgage. But Chancellor's saying we have to look way deeper. It's not just a bank fee.
So we have to strip away all the jargon.
Exactly. The core idea from economists like Boom Bawerk back in the 19th century is actually pretty simple.
Which is?
Interest is the price of time.
Okay, but why does time even have a price? If I borrow $1 from you, why does the time I hold it cost me anything?
It's because of something they call time preference. It's a very human thing. We're impatient.
Meaning, I'd rather have a piece of cake today than be promised that same piece of cake in 5 years.
Precisely. You have a preference for now versus later. If there was no price on time, no interest, then an apple today would be worth the same as an apple promised in 100 years.
Which is obviously absurd.
Right. So the interest rate is just the discount you apply to that future promise. The 18th century economist John Law said it best. Anticipation is always at a discount.
And this isn't a new idea. You mentioned Mesopotamian farmers.
Not at all. We're talking 4,000 years ago. Credit was common, and interest wasn't paid in, cash.
It was paid in the commodity itself.
Exactly. Silver or barley. They understood that the lender was giving up something valuable right now.
Okay, so that grounds the idea. It's fundamental. So what is interest supposed to do in a healthy economy? What's its function?
Its main job is to reward patience, to encourage saving. Francis Bacon pointed out that interest is what pushes people to save, which then provides the capital for big projects.
You mean like building a factory or developing new technology?
Yeah, all the advances that are crucial for commerce. It's like the entire economy's version of the marshmallow test.
You get a reward for delaying gratification, for not eating the marshmallow right away.
Exactly. That reward, that interest, it encourages people to abstain from spending everything today. And that pool of savings is what fuels long-term growth.
Okay, so that's where the problem starts. What happens when governments or central banks come in and make borrowing basically free?
Well, you're flipping the incentive completely. If the reward for waiting is zero, or even negative after you factor in inflation,
then why wait? Everyone wants everything now.
and the system starts to systematically reward borrowers, people taking on risk, at the expense of savers.
The savers are the forgotten man, as Michael Burry called them. They get punished for being prudent.
Yes, their reward for patience disappears. But let's dig into the confusion here, because the story we always hear is that cheap money is a good thing.
Right. That's the whole argument. The central bank lowers rates, your mortgage gets cheaper, the stock market goes up, and the economy gets saved from a recession.
That was the official rationale, for sure.
And this is where things like quantitative easing come in.
Yes, QE. I think we should quickly explain that.
Definitely. When people hear central banks printed trillions, what does that actually mean?
In simple terms, the central bank, like the U.S. Fed, creates new digital money.
It's not literally printing presses?
No. It's all digital. They use this new money to buy financial assets, like government bonds, from commercial banks.
Which floods the system with cash.
Exactly. It pushes down long-term interest rates and makes capital super cheap and abundant. And the justification was always price stability. As long as inflation was low, around their 2% target, they thought this was safe.
They saw low rates and all this money creation as a good way to keep the economy moving without prices at the grocery store getting out of control.
They did. But that view had some really powerful critics.
Like who?
Even the former Fed chair, Paul Volcker. He was baffled by this obsession with the 2% target. He called the idea of pumping up the economy when it was already strong just because inflation was a little low nonsense.
So Volcker was saying they were looking in the wrong place. They were watching the price of bread, but ignoring a huge storm brewing somewhere else.
That's it. And economists like Claudio Borio and Hayek had been warning about this for years. They pointed out that the biggest crashes, 1929, 2008, they both happened when consumer inflation was low and stable.
So speculative manias, these huge bubbles, they actually grow best when things seem calm on the surface.
Yes, that low inflation was giving policymakers a false sense of security. Which brings us to Chancellor's big metaphor for all of this. He calls it signal jamming.
Signal jamming. So how does that work? What signal is being jammed?
The interest rate. He argues it's the most important price in any market economy. It's like the system's beating heart. It tells you where to invest, what's a good risk, what isn't.
And when a central bank sets that price artificially low, it messes up the signal.
It jams it completely. And that leads to this concept of malinvestment.
Okay, that sounds like jargon.
Yeah.
What is malinvestment in simple terms?
Think of it like a hurdle. Every business project, whether it's building a new factory or launching an app, has a hurdle rate. It's the minimum return you need to make the risk worthwhile.
So if money is free, the hurdle basically disappears.
It drops to almost zero. So companies start investing in all sorts of crazy long-shot projects or businesses that aren't really viable just because the capital doesn't cost them anything.
So if funding is free, why not throw money at some wild idea that might pay off in 30 years? The incentive for discipline is gone.
It is. And this also creates the zombie phenomenon.
Oh, yes, the zombie companies.
These are firms that are basically dead. They don't make enough profit to even pay the interest on their debt.
But they don't fail.
No, because they can just keep borrowing more cheap money to stay afloat. They shamble along, clogging up the economy.
Tying up capital and workers that could be used by newer, more productive companies.
And the Bank for International Settlements found a direct link. The more policy rates fell, the more zombie companies you got. It's clear cause and effect.
We saw this in the tech sector too, right? With all the unicorns.
Absolutely. Chancellor points to Uber as a classic case of malinvestment. For years, the company basically subsidized every single ride with cheap investor money.
But hang on, millions of people use Uber. It's convenient. Isn't that a success?
It's a success in terms of consumer utility, yes, but not productive efficiency.
What's the difference?
The incredibly cheap capital meant anyone with a car could become a driver. This created a huge oversupply of drivers, which pushed down their productivity and their wages. The free money didn't just enable a company that lost money for years. It lowered the bar for what was considered productive work.
Wow. Okay, that brings us straight into real life, the everything bubble.
And inequality. This is why you, as a listener, should care about the price of time.
Because it's hitting your wallet directly.
Yes. Chancellor warns that every great bubble in history happened during periods of easy money. And the money printing in 2020 and 2021 created what he called the everything bubble.
It wasn't just stocks. It was real estate, art, vintage cars, crypto.
Everything. And who owns those assets?
The wealthy.
That-
So as the value of those assets skyrockets, it's a massive transfer of wealth upwards.
That's the inequality engine right there. After 2008, the mean wealth, which is pulled up by the very rich, recovered just fine. But median net wealth for the average person in many countries never recovered. It's still below pre-crisis levels.
And for the middle class, it's what they call financial repression, right?
Exactly. The wealthy own assets that grow in value.
Yeah.
The middle class mostly holds cash in a savings account.
Where the interest rate is zero.
So even a little bit of inflation is silently eating away at your savings. Your capital's just being eroded. That's the broken social contract.
Which brings us to the biggest one for so many people, housing.
Of course. Housing costs have shot up way faster than wages or regular inflation. The low rates made mortgages seem cheap, which just fueled a frenzy of demand.
And turned housing from a place to live into a speculative asset to flip.
Without doing anything to solve the actual shortage of supply. Meanwhile, anyone trying to save for retirement,
Your pension fund, your 401k,
they were forced to go yield chasing.
meaning they had to buy riskier and riskier things just to get any kind of return?
Right. They couldn't make money from safe government bonds anymore, so they piled into the stock market or risky corporate debt, taking on way more risk than they should have.
So if the whole system is built on this mountain of debt, and it all depends on low rates to survive, what happens next? Are we just waiting for a crash?
Well, that's the practical insight here. The debt trap.
Which is what exactly?
The economist Claudio Borio calls it a debt supercycle. We have so much government and corporate debt now that we need low rates just to be able to pay the interest on it all.
It's a trap. We have too much debt because of low rates, and now we need low rates because we have too much debt.
It's an accelerating feedback loop. And it wasn't just governments. This cheap debt fueled a massive merger wave after 2008.
The buyout barons in private equity, how did that work?
A private equity firm could borrow huge sums of money at almost zero interest to buy a company.
A leveraged buyout, or LBO.
Right. Then they'd load all that debt onto the company they just bought, strip out any value for short-term profits, maybe by firing people or selling off assets, and pay themselves huge dividends.
All without making the company more productive in the long run.
Exactly. It rewarded financial engineering, not genuine business improvement. It's a big reason why productivity growth has been so weak.
Given that Chancellor correctly called the dot-com bubble and the 2008 crisis, these are pretty serious warnings.
They are. When the book came out, some financial experts were literally telling people to sell everything because the distortions were so extreme.
Okay, let's bring this all together. The synthesis. If you had to explain this whole problem to a teenager, what's the simplest way to put it?
I think we first need to understand one more concept. The Greenspan put.
Right, that's some market jargon. What is it?
It's basically the belief among investors that the central bank will always step in to save the market if it falls too far. It's a safety net.
So it encourages people to take huge risks because they know they'll be bailed out if things go wrong.
Precisely. And that idea leads straight to the best metaphor for this whole men, the arsonist and the fireman.
Okay, I like that. Who's the arsonist?
The central banks. They are the arsonist, pouring gasoline, that's the cheap money, and the QE all over the financial system. This creates the bubbles and the instability.
The fire.
Then, when the fire starts and the crisis hits, they rush in as the heroic firemen to put it out with even more gasoline.
They create the very problem they then get credit for solving.
And often they felt they had to do it. They saw a structural problem, like Japan's aging population causing slow growth, and they misdiagnosed it as something that could be fixed with a quick shot of cheap money.
So what's the ultimate risk here? If this keeps going, where does it end?
Chancellor's conclusion is pretty stark. He suggests that eventually central banks would have to become the entire financial system.
Meaning the government would have to replace private banks as the main lender? State investment would replace private investment.
Yes, a completely centralized and ultimately unstable system that needs more and more rules just to manage the distortions it created in the first place.
So to wrap it all up, interest is the price of time. When you distort that signal.
You distort everything. You get malinvestment, you get bubbles, you get this massive inequality we're all living with.
So the takeaway for you, the listener, is to understand that fundamental signal, that price of time, because it changes how you should think about your own savings, your investments, and what you're being told about the economy.
Think critically about the hidden costs of free money, knowing this is your best defense.
We hope this deep dive gave you some new ways to see the world.
And if you want more ideas to get ahead, be sure to subscribe to Nonfiction Insights.
Nonfiction Insights.